Have you noticed silver prices moving dramatically lately? If you're holding silver, thinking about buying it, or just curious about what's happening in precious metals markets right now, what I'm about to share could change how you think about your investments. And before we dive in, if you want to stay informed about real market insights without the hype, hit that subscribe button and turn on notifications. I'm committed to bringing you facts, data, and balanced perspectives, and your support helps me continue doing that. Now, let's talk about what's actually happening in silver markets and why it matters to you. Right now, we're seeing something interesting in the silver market. Prices have been volatile, margin requirements have changed, and there's a lot of conversation about physical versus paper silver. But here's the thing. Most of what you hear online is either overly optimistic or designed to scare you. My goal today is to give you the facts so you can make informed decisions for yourself. Let's start with the basics, because understanding what's actually happening requires knowing how silver markets work. When we talk about silver, we're really talking about two different markets. There's the physical market, where actual metal changes hands, bars, coins, bullion. And there's the paper market, where futures contracts, ETFs, and derivatives allow people to gain exposure to silver prices without actually holding the metal. Both markets are legitimate, and both serve important purposes. The futures market, primarily through exchanges like COMEX, allows producers, manufacturers, and investors to manage price risk. A solar panel company might use futures to lock in silver prices months in advance. A mining company might use them to guarantee a selling price for silver they haven't even extracted yet. These are normal, healthy market functions. The paper market provides liquidity and price discovery. It's not inherently manipulative or fraudulent. It's just a different way to participate in silver markets. Now, here's where things get interesting. Margin requirements on silver futures have indeed increased recently. Let me explain what this actually means. When you trade futures, you don't pay the full value of the contract up front. You post margin, essentially a good faith deposit. If margin requirements are $20,000 for a contract, you control a much larger amount of silver with that deposit. When exchanges raise margin requirements to $30,000, $40,000, or even $50,000, it means you need more cash to hold the same position. Why do exchanges do this? The official reason is risk management. When markets become more volatile, when prices swing dramatically, exchanges increase margins to ensure traders can cover potential losses. This protects the clearinghouse and maintains market stability. Think of it like a landlord asking for a bigger security deposit when renting to someone with uncertain income. It's about reducing systemic risk. But here's the question everyone's asking. Is there more to it? Some analysts argue that raising margins during price rallies disproportionately affects smaller traders while allowing large institutions to continue operating. This is worth considering. If you're an individual with $50,000 to invest, putting all of it up as margin for one contract is risky. But if you're a bank with billions in capital, posting $50,000 per contract is barely noticeable. So yes, higher margins can create barriers for smaller participants. Does this mean the market is rigged? That's where we need to be careful. Markets are complex systems with many participants, each with different motivations. Are there instances of manipulation in commodity markets? Historically, yes. JP Morgan did pay significant fines for spoofing in precious metals markets. Other institutions have faced penalties too, but concluding that every price movement or rule change is manipulation oversimplifies reality. Let's talk about what we can actually observe right now. Physical silver premiums, the amount you pay above spot price for actual coins or bars, have been elevated in various markets. In some Asian markets, premiums are noticeably higher than in the United States. Why might this happen? Several reasons. Import restrictions, local demand dynamics, currency considerations, and yes, sometimes supply constraints. China did implement export controls on certain materials, including some related to precious metals refining. This can affect regional pricing. But here's what's important to understand. Premium variations between markets aren't necessarily proof of a conspiracy. They often reflect logistics, local taxes, currency exchange rates, and regional supply and demand. If silver costs more in Tokyo than in New York, it might be because of import duties, shipping costs, currency strength, or local demand outstripping local supply. These are normal market phenomena. Now, let's address inventory levels because this is where data actually matters. COMEX does publish inventory data, and it's publicly available. Registered inventory, silver available for delivery against futures contracts, has declined over recent years. This is factual. Does this mean we're running out of silver? Not exactly. It means less silver is being stored in COMEX warehouses, specifically designated for futures delivery. Silver might be in other warehouses, in ETFs, in private vaults, or in industrial stockpiles. The total above-ground silver supply is much larger than what's registered at COMEX. Could there be supply-demand imbalances? Absolutely. Silver is used extensively in industrial applications. Solar panels, electronics, electric vehicles, medical devices, these all consume silver. Unlike gold, which is mostly held as an investment, silver gets used up. If industrial demand increases while mining production stays flat or declines, you could see tightening supplies over time. This is a legitimate fundamental factor to watch. Here's something I want you to think about. And please share your thoughts in the comments because I'm genuinely curious what you think. If you're considering silver as an investment, what's your primary motivation? Is it industrial demand fundamentals? Is it protection against currency devaluation? Is it portfolio diversification? Your answer matters because it should influence how you approach silver. If you're interested in silver for industrial demand reasons, you'd want to research trends in solar energy adoption, electric vehicle production, and electronics manufacturing. These drive real demand. If you're interested in silver as a monetary hedge, you'd want to understand monetary policy, inflation trends, and historical relationships between precious metals and fiat currencies. If it's about diversification, you'd want to look at correlation with other assets in your portfolio. Different goals require different approaches. Let me share what I think is important about physical versus paper silver without the fear-mongering. Owning physical silver means you have actual metal. There's no counterparty risk. If markets freeze, if systems fail, you still have your silver. The downside is storage costs, security concerns, and less liquidity. You can't instantly sell physical silver at 3 in the morning if you need cash. You also pay premiums when buying and take discounts when selling. Paper silver, through ETFs or futures, offers liquidity and convenience. You can buy or sell instantly. There's no storage concern. The downside is counterparty risk. You're trusting that the institution backing the ETF actually holds the silver they claim. For most established ETFs, this trust is probably warranted. They undergo audits and face regulatory oversight. But it is a consideration. My personal view, and remember this isn't financial advice, just one person's perspective, is that both have a place depending on your goals. If you want long-term wealth preservation and you're willing to accept less liquidity, physical might make sense. If you want to trade price movements or maintain easy liquidity, paper instruments might be more appropriate. Many investors do both, holding some physical for security and some paper for flexibility. Now, let's talk about what could happen next, and I'm going to give you multiple scenarios because anyone claiming certainty about markets is selling something. Scenario 1, silver prices continue rising. If industrial demand stays strong, if investment demand increases, if supply remains constrained, prices could move higher. This would benefit anyone holding silver in any form. Higher prices attract more mining production over time, which eventually increases supply and stabilizes prices. This is how commodity cycles typically work. Scenario 2, silver prices consolidate or decline. If industrial demand weakens, if investors shift to other assets, if new supply sources come online, prices could fall. This would hurt anyone overexposed to silver. Remember, silver fell dramatically after its 1980 peak and took decades to recover. It could happen again. Anyone telling you silver only goes up isn't being honest about historical reality. Scenario 3, we see continued divergence between physical and paper prices in certain markets. This could reflect ongoing supply chain issues, regional demand variations, or changing market structure. Over time, these divergences typically narrow as arbitrage opportunities attract capital, but they could persist longer than expected if there are genuine logistical or regulatory barriers. Here's what I'm watching personally, and you might want to watch these indicators too. First, industrial demand data. Silver's industrial uses make this crucial. Second, mining production trends. Are major producers increasing output? Third, central bank policies. Monetary policy affects all commodities. Fourth, the US dollar. Silver typically moves inverse to dollar strength. Fifth, real interest rates. Negative real rates historically support precious metals. These are the fundamentals that actually matter over time. Let me address something directly because I know it's on many people's minds. Is there manipulation in silver markets? My honest answer is that markets involve human beings, and humans sometimes cheat. We have historical evidence of manipulation in various commodity markets. We have fines paid and settlements reached. So it would be naive to claim manipulation never happens. However, it would be equally naive to claim every price movement you don't like is manipulation. Most of the time, prices move because of supply, demand, and market sentiment. Sometimes manipulation occurs, but it's typically short-term and eventually gets discovered and penalized. What should you do with this information? First, do your own research. Don't take my word for anything. Verify data. Read primary sources. Look at exchange publications, mining company reports, and industrial demand forecasts. Second, understand your own risk tolerance. Silver is volatile. If you can't handle watching your investment drop 30 or 40% temporarily, you probably shouldn't be heavily invested in it. Third, diversify. Never put all your resources into one asset, no matter how convinced you are. Think long term. If you believe in silver's fundamentals, short-term volatility shouldn't shake you out. And here's something important I want to emphasize. Be skeptical of anyone who uses extreme fear or extreme greed to motivate your investment decisions. If someone's telling you the entire system is about to collapse and you need to buy silver immediately, they probably have something to gain from your fear. If someone's telling you silver is guaranteed to make you rich with no risk, they're lying. Real investing involves uncertainty, risk, and the possibility of being wrong. Before we wrap up, I want to hear from you. Drop a comment telling me, do you currently hold silver? Are you considering it? What's your biggest question or concern? I read every comment, and I'll respond to as many as I can. Your engagement helps this channel grow and helps me understand what content you actually want to see. And if you found this analysis helpful, share it with someone who's trying to understand silver markets without the hype. Real education beats fear-mongering every time. Now let me leave you with a few final thoughts. Markets are complicated. Silver has legitimate industrial demand, legitimate investment appeal, and legitimate risks. Anyone claiming to know exactly what will happen next is guessing, even if they sound confident. The best approach is to educate yourself, understand both bull and bear cases, manage your risk appropriately, and make decisions aligned with your personal financial situation and goals. The difference between successful investors and unsuccessful ones usually isn't that successful investors are always right. It's that they manage risk, diversify, think long-term, and don't panic during volatility. They also don't get greedy during manias. They stay balanced and disciplined. If you're interested in silver, learn about supply and demand fundamentals. Understand industrial uses. Know the difference between physical and paper. Recognize that prices can go down as well as up. Accept that uncertainty is part of investing. And never invest money you can't afford to lose. These aren't exciting principles, but they're the ones that actually work over time. I'll be continuing to cover precious metals, market dynamics, and investment education on this channel. Subscribe to Money Aftermath so you don't miss future videos. Turn on notifications. And remember, the goal isn't to make you react emotionally, it's to help you think clearly. Thanks for watching, and I'll see you in the next one.